But let's bring on board Mayuresh Joshi, fund manager at Angel Broking, first to talk about his market opinion. And Mayuresh, morning. The way we've been slowly grinding lower and now close to testing the 80-50 mark, given how disappointing largely earnings have been so far, it seems like 8,000 as well could be tested soon.
Good morning, Aisha. Clearly, I think when we started off the earnings season, it was expected to be soft and sluggish. And the way that things are moving along, specifically on all segments of the market, whether that's the banking sector, we've seen huge amount of asset recognition probably come through. The testimony to the fact being IDFC's numbers as well. The infrastructure part not picking up, that's been very evident from what we've seen in L&T numbers. So clearly I think the basic tenets that the markets were working on in terms of at least the banking and the financial institutions doing well, a part of them have probably done well. But again, I think the sluggishness in our opinion would continue. We are expecting probably, I think, the earnings recovery to not start before the first half FY17. And if the CAPEX cycle is delayed for some reason or the other, I think that earnings recovery might get delayed even further. So again, I think the markets are resetting themselves to the fact that earnings are not going to recover so soon, and the short to medium term triggers for the markets might just be there in terms of how the Bihar election outcome might come through. If it turns out favorably, I think the markets might have some amount of uptake, but clearly the markets will then again start realigning to the fact whether earnings are catching up, which is not the fact. And clearly, even in terms of how the reforms delivery will start happening, since the winter session will also start in the next few weeks time. So again, I think range bound activity for the markets. So I think it is more stock specific action rather than the markets, and there is every possibility that the markets might come back to those 7,600, 7,700 levels.
Mayuresh, the universal consensus was that India was the best relative trade and India was the best absolute trade when world was falling apart in the month of August and September. And the month of October, even though all major markets have made a roaring comeback, India has emerged as the mark underperformer. We are nowhere close to its all-time high. The Dow in the month of October appreciated by about 8.5%, great Indian markets appreciated by only 2%.
Morning, Nikunj. I think the long-term structural story of India does stay intact, and clearly if you're talking about the emerging pack as a whole, India does stand out among the rest. I think you're not exposed to the commodities universe as is a lot of the emerging markets like Brazil or Russia. And again, I think when you're talking about the reform processes probably coming through, I think if it does come through the next few months, I think the kind of acceleration that one probably would see in GDP numbers, in the kind of front-loading the government has done in terms of capital expenditure, some green shoots are probably evident in terms of how the project wins and project initiations have started, at least from the government side. So it is only the private capex that needs to follow suit, which is taking time. And again, I think if you delay that by another couple of quarters, which effectively means earnings getting delayed by at least 2 to 3 quarters, I think the markets probably are taking that into their stride. Point number 2, probably for India, at this point of time, I think we're better placed in terms of how earnings are panning out generally. So I think if you're talking about larger universe with crude oil corrections happening across the globe, you've seen massive capex cuts being taken, not just by the governments, but even by a huge amount of companies. So if, for example, Chevron has cut its capex plan, it's cut jobs worldwide, and clearly that is an indication of how dismal global growth is probably coming through. So I think India is probably standing out on that sense, at least on the domestic consumption part. And again, I think in terms of falling input prices, I think the earnings recovery in terms of gross margin expansion for a lot of companies which are probably dependent on crude oil derivatives and a lot of other input costs in terms of commodities would actually start benefiting. So it's the top line growth that we're probably worried about at this point of time. But I think those that recovery as well should start happening in the first half of FY17. So largely, I think, Nikunj, over the next few months, we might be range bound, but I think India remains in a sweet spot.
Let's start with the big one. And L&T numbers came during market hour on Friday. Markets have reacted on Friday. Brokerages have reacted on Saturday. What's the immediate downside for L&T now that they have convincingly cut their revenue guidance and their order intake guidance?
Again, Nikunj, I think in terms of how the order flows were panning out, we were estimating 32,000 odd crores to come through. 28,500 has come through. But again, I think if you go by the run rate, the kind of expectations we had from the management of a 15% order inflow guidance year-on-year improvement, I think that was not supposed to happen, and that was not going to happen. So clearly, I think the markets are disappointed with the 5 to 7% order flow guidance that L&T has given. But again, I think for the reasons mentioned earlier, I think you've seen fall in crude oil prices, so international orders will see a massive drop probably coming through. Specifically on the hydrocarbons part, I think what we're going to see is selective bidding happening from L&T. I think the management was very, very clear even in the last quarter's con call. And clearly, I think they're expecting more orders to come through from downstream. I think infrastructure is the biggest element in terms of revenue contribution for L&T. The order wins have been quite substantial in terms of new order flows coming through, 58% for the infrastructure sector. But clearly, I think the drag on earnings will still continue. I think the capex recovery is not going to happen, as I mentioned earlier as well, and that is probably going to even take a toll in terms of execution happens on the domestic operations, and international operations staying weak on the on the back of crude oil prices having seen a massive correction. So clearly, I think not ruling out a 4 to 5% correction onto the stock, but with non-core asset sales probably coming through, we still believe the long-term story for L&T is intact. So 4-5% correction is not ruled out.
Right. Okay. Just stay with us, Mayuresh. Got a new listing as well today, and Cafe Coffee Day is going to list today. So remember, the IPO got subscribed about almost 1.8 times at 316 to about 328 price band. They've allotted about 1.04 crore shares, 17 anchor investors at the toppish end of about 322 bucks per share. They've raised about almost 334 crore rupees from the share sale to anchor investors. But suffice to say, we could not, or rather, one can't really play for a trading pop in this one, considering how bleak the response has been to the issue. But Amnish Agarwal, Senior VP Research at Prabhudas Leeladhar, joins us right now on the show to talk about whether the business model is that attractive or not. Amnish, hi, good morning. A word really on CCD and its operations. Does the business become a good buy right now, or is it fundamentally looking sound and strong?
You see, there are two parts to it. One being that the company which is being listed, that is Coffee Day Enterprises, the coffee business is just a part of it. Because in addition to the coffee business, you have investments in Mindtree and Sikal Logistics, then you have got some your IT parks, and then you are having some other investments in the group companies like his hospitality, etc. So when you are buying this stock, you are not buying just into a, you can say, the coffee chain, you are buying into the other businesses. Now when you come to the coffee business, even in the coffee business, 25% of your top line is coming from coffee exports, which is potentially only a 2 to 3% margin business. And excluding that, your coffee vending and cafes, they account for roughly around say 75% of the total coffee business. And our estimate is that potentially coffee vending, which is say nearly 280 odd crores out of 970 of vending, and that is a higher margin business potentially in comparison to cafes. So the most attractive piece of the business, which is usually, you can say, the retail or the cafes, they are not a very, very big part of the total business, and potentially they are not as profitable as they are thought to be, although the brand continues to have the attraction, and it's one of the marquee brands which any Indian company has created.
So the way to value CCD Enterprises is that one should look at like an holding company, and globally and at least locally, holding companies, they trade at a discount. So do you think Cafe Coffee Day Enterprises also will not get its bit?
You see, that is one of the reasons why the stock didn't get a very overwhelming response, because it will get the holding company discounts, because the amount of money of the company which is locked up in investments is quite huge. There is a debt of say roughly at the gross level of close to say 40 billion rupees, and most of it is due to the non-coffee business of the company. So although the coffee business seems to be reasonably good, it will perform well. They are going to expand the cafes, they are going to refurbish them, they are going to increase the vending machines. It generates an EBITDA of say close to 190 odd crores. It's repaying some debt over there. So as of now it's giving you losses, but from next year it will be profitable. But at the end of the day, The other businesses, that is your non-coffee businesses, they don't bring much to the table because of the huge debt which is there.
Mayuresh, what is your understanding of how CCD will list today? And after a flat listing, do you think one should buy into the stock?
So Nikunj, I think I'm not a big fan anyway of commodity-driven plays, and if you look and go by the numbers, yes, I think there's been a 30% CAGR in terms of how the top line has grown to 2,579 odd crores. I think there have been losses at the bottom line level of 87 odd crores. But again, I think the kind of holding structure that the company has got, and as the analyst was mentioning correctly, I think you really can't assume what kind of discounting will probably happen to the holding company. So it's a complex structure, I think, in terms of how profit losses these subsidiaries are making. I think they're doing marginal contribution in terms of overall top line growth, margin expansion, and again, valuations remaining expensive. So again, I think largely commodity driven. If it was only the coffee business, I think yes, I think it would have derived greater valuations, but the consolidated debt taken on the entire book and the coffee business just being a minuscule part of it, I think it is not attractive at this point of time. So I expect the stock probably to open lower once it lists today.
Okay, that's that on CCD, which is going to list today. But Amnish, good chatting with you. Thanks much for sharing your opinion on CCD. And Mayuresh, you stay back. Lots more to chat about with you. But Sandeep, come to you on that note. What else is looking good for a trade right now? Any stocks that you may have on your mind?
Aisha, I have two buys. I had talked of three sells, namely a Hexaware, Wokat and an ITC. In case of a bounce back, which is very much possible, I would go long in a Eicher Motors, which is showing strength. Some more upside very clearly evident. Buy it with a stop loss of 17,510, target of 18,306, and a buy in a KTK Bank, which excelled on Friday again. Buy it with a stop loss of 124, target of 138.
Okay, that's the opinion then coming in on some of the technicals. But Sandeep, some of the other stocks which were rather active, and I want to talk about Sun TV, that trading spurt that you saw in the stock in Friday's session. Of course, there's still some confusion on whether or not it's the promoters buying back stake in the company or it's the company itself which is buying back, in which case the movement in the stock is going to vary. The stock came off from the top, but how would you trade it today?
Aisha, the view is positive, though I'm not that greatly enthused. At a level of 396, a move towards 415, 420 is very likely. But in that area, it faces a very strong resistance. So I would talk of a limited upside. And I don't think 370 would be broken. So as of now, 370 to 410 is the range. Probably on an upper side, 425, 430 is where it can stretch to. But at those levels, I would recommend booking some profits.
Okay, earnings and more earnings. Let's bring on board S. Subramaniam, CFO at Titan, to highlight how the earnings have been. Mr. Subramaniam, what has been the factor responsible for such a sharp drop in the numbers this quarter?
In the last year, we had to stop the Golden Harvest scheme that we were running. It was a scheme where we used to save, we used to allow customers to save 11 installments, and then the 12th installment was being given as a discount when they come and redeem their purchases. The issue was that under the Companies Act last year, this was brought under the ambit of a public deposit, and therefore we had to stop the scheme as it was running and start the new scheme afresh. Now the issue here was that this was the quarter where we had to do this premature redemption last year. And it resulted in a huge sale in the corresponding period last year. So we had almost 54% of our revenues coming in from the premature redemption of this scheme. So we always had a problem with the base. So that was going to be the case in any case. And we've been talking about the fact that there will be a decline, and a significant one in this quarter in comparison, therefore, to the previous year. In addition to that, of course, there was also this factor of the diamond studded activation. Traditionally, we have the activation or the promotion in the second quarter, which is generally in the months of July and August. This year, we had advanced that to June because there was the apprehension that possibly there would be the 1%, 1 lakh PAN card requirement, etc., coming in from July. So we had advanced it a little. That did not happen, and unfortunately, therefore, we got impacted both ways. So one was, of course, the GHS impact. The second one was our own activation, which definitely gives a significantly higher margin.
Right. Well, the extreme nervousness in the numbers is also factored in this quarter because of the golden harvest scheme ending. Does it mean that Q3 will be better than Q2, or will the pressure continue sequentially as well?
I'm sure we will start growing in from Q3. We've had a fairly decent Dussehra so far, and we are definitely expecting to have decent growth starting from Q3 onwards. First is we hope the market itself picks up a little, but importantly, as far as we are concerned, we won't have the base effect of the GHS impact of the previous years. And thirdly, we ourselves will start getting in the impact of the benefits of the new GHS plan, which we launched last year in November, to start kicking in from December this year. So we will have therefore a benefit of that as well. So going forward, Q3, Q4 onwards, I think we should be on a fairly decent growth path.
So how challenging was this quarter for you in terms of other things, let's say the impact of gold imports, etc.?
Gold prices were lower by about 7%, and that obviously will have an impact on the top line as well, because it's not that people make it up in terms of quantity. However, having said that, as there was a sharp correction in the month of July, August, we did see some spurt, but that was just that. It was a mini surge, and it lasted only for about a month or plus. And after that, it was quite slow. I think overall, if you were to ask about sentiment, I think sentiment has been fairly weak. I don't think things have been much better on the gold jewelry side, and overall consumer sentiment and consumer discretionary spend has not been all that great. Maybe some of this has to do with maybe e-commerce players doing better, the growth in the e-commerce scene being better, so therefore possibly some share of wallet shift, etc. But having said that, I think we are coming out with more exciting products, and the recent collections, particularly in jewelry, have been very, very successful, all the things that we've launched now. So one is hopeful for the future, yeah.
So how are you preparing for the festive season that will also likely boost the next quarter sequentially?
Yeah, absolutely. I think, as I mentioned earlier, I think the Dussehra season has been quite good. We've grown quite well. It's about 20% that we've grown, and that we expect to continue for the quarter as a whole. So, I mean, at least that's what we are aiming for. So, I think we should be looking at better days going forward.
Tell us, how did the other segments of business, let's say eyewear, watches, etc., have registered growth for the quarter gone by?
Watches grew by about 4.4%, but a large portion of that growth was because of export sales. Exports was doing much better this year than possibly domestic. Domestic was flattish, about 1% or so growth. So on top line, there is a pressure on growth. Consumer sentiment is just one of the reasons, but that's something that we are working on with possibly new products coming in and launches coming in the festive season. But on the margin side, we did exceptionally well. We came back to our 15% margin. Of course, that was helped to quite some degree also by a lower ad spend this year compared to the previous year. But the point is, I think we are moving towards a higher gross EBIT margin sequentially because a lot of work is happening on the cost side. And the good news also is that the premiumization journey that we were undertaking for Titan as a brand is now yielding fruit. The ASPs are rising, which is good for margins as well. So I think it's going to take some time. We need some tailwinds in the form of consumer sentiment push, but we are doing our best as far as we are concerned till such time mood changes. And when it does, I think we should grow very, very well. As far as eyewear is concerned, there was a reasonable growth, 15% we grew. Of course, there was some concern on the like-to-like store sales, which was about 1% only. The growth was only about 1%. But the business is still doing well. There is some competition, of course, but there are also others who have come in and who are now facing the pressure. So I think eyewear will do well. I think it's a long-term story, and we expect to do quite well in that category as well.
Mr. Subramaniam, pleasure speaking with you, and it'll be good to see how the markets as well absorb the numbers. And we're going to take a very quick break then on this edition of the market. When we come back, the pre-open rates this Monday morning.
Well, we are not working with excellent set of both local and global cues. Well, globally, you can't make a case that everything is looking bad, but locally, I think the center of gravity clearly has shifted from macro to earning concerns. Macro setup is favorable, but markets are clearly disappointed with numbers which have come out so far. String of disappointments, starting from an ITC to an L&T to an Axis Bank. In fact, some of the stalwarts this time, where expectations of growth was there, they've reported contraction. So markets clearly will adjust, and this is more like an earnings stroke fundamental adjustment which will push us back. For the moment, it appears that this market has a roof in place. And will we go below 8,000? Well, the pre-open rates are indicating that today a test or retest of 8,000 on the Nifty could be on the cards now. And this is happening at a time when the global environment and the global backdrop is supportive. Apart from earnings, today it's all about auto dispatch numbers. Expectations are running high because the month of October will be an important month, especially because this is a time when bulk of Dussehra and Diwali pre-sales have been got captured. Mahindra & Mahindra 1220, Ashok Leyland 94, Tata Motors and Maruti. Maruti is the big one where expectations are running extremely high. Let me just turn my attention to L&T, which came out with a very disappointing set of numbers, nothing short of a shocker when they cut their guidance for FY16. Brokerages are still ready to give L&T a benefit of doubt because valuations are not that stretched. But 1420 for L&T, Axis Bank, IndusInd Bank, L&T, these are some of the movers. As of now, it's just one of those rates where you can't interpret anything, Asha.
Absolutely quiet to start off the day, at least for the headline numbers on the indexes. I want to see what ITC as well as L&T are up to and whether or not you're seeing some follow-through pressure from Friday. Sure enough, ITC starts off a little tempered, but I think L&T is going to be the bigger one to really look out for after that deep plunge on the stock in Friday's session post a disappointing earnings set, a guidance cut, and more importantly, extremely bleak management commentary. L&T is the stock that I'm talking about. That will just come up for you on your screens. Slew of other things that you need to look out for. L&T starts off quiet, but perhaps that rate is going to change once the normal market kicks in. Sun Pharma, considering how disappointing Dilip Sanghvi's commentary has been, he says that they are incurring integration charges for Ranbaxy deal and that Ranbaxy integration will hurt their FY16 profits. Sun Pharma has started off sharply lower by about almost 1%. The Systema Arcom deal, let's see what Arcom is up to, and I also want to see what an Ashok Leyland, Bajaj Auto, Hero MotoCorp, etc. would be up to, considering the numbers are slated to come out today, the monthly sales numbers, that is. IOB, it's been a disastrous set of numbers this time from them. The net loss has come in at 550 crore rupees versus 644 crore rupees of a comparable loss figure. The NII is marginally higher but flattish yet again, and it's the NPAs which have risen, both net as well as the gross. It's a case of higher provisioning towards the advances, which clearly seems to be leading to the loss in the second quarter. But let's also bring on board Manisha and try and analyze how the currency markets had kick-started trade. Manisha, what are the first rates like?
Thank you for that, Aisha. Well, 10 paisa down on your screens is how the rupee has started its trade for the day today. Well, the gains seem to be capped for right now because we are looking at euphoria around the debt markets really weighing down. Also, the Fed is sounding more hawkish. And it's not just the rupee. If you look at across segments and money market, that really seems to be the case right now. Take a look at the bond markets, and they seem to have extended weakness yet again today. The expectation of a firm labor market recovery in US, also subdued domestic appetite, will ensure that you see the bonds ranged between 7% 7.59 to 7.69% for this week. It's the same case for the corporate bonds as well. The lackluster sovereign curve, also FPI interest in the corporate debt waning as well, is something that seems to be pressurizing that area. Having said that, this is yet another week where you have loads of data coming in. We already have seen the Chinese PMI numbers come out. It also is about Japan and US PMI numbers today. Thailand, Malaysia, India also are coming out with their PMI numbers. So markets would keep a keen eye on to that one. Also, it is the US non-farm payroll data on Friday, and that would be the big event in this week to take direction from.
Right, Manisha, thanks a lot for that. Well, it may not be a very macro-heavy week, but frankly, this week you've got a slew of PSU banks which will come out with their numbers. And if private banks have suffered, and if IOB numbers are a lead indicator of anything to go by, I'm just keeping my fingers crossed, hoping that there is no bombshell any of the banks they drop. The economic conditions are poor, recovery has not happened, metal sector is in a disarray, and steel is where the real problem is for some of the banks in terms of an exposure and in terms of an NPA problem. But amidst all this gloom and doom which is there from the earnings season, there are individual stocks which continue to chug along, and Ajay, one such company is GHCL, Gujarat Heavy Chemicals.
Correct, and good morning, Nikunj. GHC actually reported numbers on the weekend. Pretty strong set of numbers coming in. So dealers are betting on this cash stock they believe that the stock could actually move higher in trade today. But on the downside, two short ideas also coming in. One is Sun TV. They believe that the Friday's rally actually may be very short-lived in nature. They are not very convinced the kind of move the management is taking to take away 750 crores they call excess cash on the books, and hence probably they would be also participating in the buyback. So there's a short idea coming in on Sun TV, and the IOC is also one stock which is in focus. They've cut petrol and jet fuel prices over the weekend. Results will be tomorrow. The way MRPL has reported big inventory loss, IOC also is expected to show weak numbers. So there's also one short idea from the dealer's desk.
Mayuresh, let's talk about some of your investment ideas. Then you are bullish on Maruti. Walk us through the rationale. At 4,400, at 4,500, what's the logic in buying into Maruti, which some would argue is trading at about 30 times already?
No, it will, I think, and the valuation premiums might get justified, Nikunj, for Maruti. I think the kind of numbers that Maruti is putting through, the right product mix coming through, and yes, I think there has been some disappointment on S-Cross with some heavy discounting happening on that model. But again, the Baleno launch is something that can change fortunes of Maruti. It has regained market share. The market share is close to 47.5% overall for Maruti. I think the merger with Suzuki Powertrain, I think that is going to be a huge positive in the long run. Again, I think localization efforts, largely, I think hedging the kind of imports that Maruti does. The discounting has come down in a large way. And again, I think the kind of numbers that we really expect with new launches coming through, the right product mix should work for Maruti. So clearly, I think in terms of top line growth, I think the sustainability should carry through for Maruti. The earnings growth, in our opinion, should be in excess of 35-36% over the next 2 years. And at an EPS of 225 rupees, I think there is still some steam left for the stock. So clearly, within the space itself, I think Maruti is something that we continue to like. And again, the differentiating point, Nikunj, would be that 33% of its sales only account from the rural side. So I think it's more semi-urban, urban in nature at this point of time. The dealership and the distribution network also aids Maruti in a big way.
Okay, let's also hear out what the brokerage opinion is then this Monday morning. Darshan, what are the notes that you're picking up?
See, basically, it's all negative. Three large cap companies that we've taken. First of all, L&T, in which Credit Suisse has cut the target price to 15.15 from the earlier 17.75. They're saying that the weakness that is there is structural and could persist at least in the near term. And they're saying they build in a 16% decline as far as the order inflow is concerned. And they've cut the EPS estimates for the next 2 years by 3 to 4% on lower business for the core business, lower multiple for the core business. Next is CLSA on Titan, in which they are maintaining a high conviction sell on the counter with a target price of 285. They're saying that the jewelry margin, it is at record lows, but probably should rise. And they're saying that they've cut the EPS estimates by almost 8 to 9% on lower revenues and margins that have come in the jewelry segment. And finally, CLSA on ITC is maintaining a sell with a target price of 315. What they're saying is that cigarette volumes declined another 13 to 14%, and other business performance was also rather weak this time around. They're saying that they've also toned down their expectations from the agri and paper business. So overall, in all aspects of ITC, CLSA is rather bearish currently.
Right, Darshan, thanks a lot for that. Mayuresh, coming on ITC, cigarette business is contracting. That's no longer the cash cow. FMCG business so longer. I mean, it's a pure top line business. No money is coming from that FMCG business per se. ITC has been an underperformer. Do you think there is every reason to believe that ITC will remain an underperformer?
It would, Nikunj, and again I think if you look at the cigarette business, it's more to do with the price hikes to offset the kind of excise and VAT increases that you've seen. The cigarette volume degrowth would continue as time progresses. So clearly I think the other FMCG businesses, I think the top line growth was there at around 7-8% to 2,354 odd crores if I'm not mistaken. But again on the EBIT front, things are not moving for the other FMCG business. Similarly for the agri business, because of lack of trading opportunities, specifically in soya, wheat, coffee, I think you've seen major downfall happening even on the top line. And again, I think the EBIT miss was quite evident there as well. So even on the paperboard part, we're expanding, we are expecting actually some expansion happening, but again, disappointed on the EBIT front. The hotel business is something that probably stood out. So I think if you combine all these businesses together, you're not seeing huge contribution happening either from the cigarette business in terms of bottom line in the near term, and the other businesses probably underperforming for the larger part of FY16. So yes, I think ITC, Nikunj, in my opinion, would underperform not just for FY16 but for the first half of FY17 as well.
Sun TV, Mayuresh, and I think it's imperative to let our viewers know what transpired on Friday with regards to the buyback was not the promoters buying back but the company itself, and that's not going to go down well with the street. While we did see a short covering led pop coming in on Friday, today perhaps it would be a case for selling into the stock.
So not too sure about selling into the stock, but yes, I think we're not seeing positives happening into the stock as well. So clearly within the space itself, I think Z is something that I would continue to prefer, Aisha. Again, the strong earnings momentum specifically on the ad revenue front has been quite stupendous by ZTV this quarter around. And if you're probably talking about digitalization and the kind of expectations one really has in terms of the enormous potential in terms of subscriber base, I think you're going to see subscription revenues also inch up. So I think valuation wise it's not cheap as well, but clearly on decline. Z is something that I'll still continue to prefer probably within this larger universe.
Sandeep Akle, coming on something like Z. It is part of the Nifty 50, numbers were strong and it has been a decent outperformer. Do you think Z before Diwali could be 450?
Nikunj, it has already tested 440 and it is on the way down to 410. Though I don't expect it to break 385 or so, I seriously doubt whether it will test 450 before Diwali. If you give it a little more time, then yes, the trend is up, the weekly monthly patterns are positive. But at the current levels, we have witnessed some correction and which can extend further. So move from 390 in case there is a further correction. To expect it to go to 450 more so before Diwali, very unlikely.
Okay, now just before the bell, I want to revisit the top investment ideas from Mayuresh Joshi. Two of them are on your screen. We have discussed Maruti at length. Infosys and Sun Pharma, the other two ones which we need to discuss. Okay, Mayuresh, Sun Pharma. I'm sure you must have read over the weekend the management commentary. Ajay alluded to that management commentary, and it's evident that FY16 will be a washout year for Sun Pharma. So if things in the short term are painful for Sun Pharma and if others are doing well, why should one buy into Sun Pharma?
So again, Nikunj, I think this is these classical examples that when things are not doing so well, and again I think the market's largely discounting the kind of apprehensions the stock is going through. FY16 expected to be a washout year for Sun Pharma. There are issues with their Halol facility, the integration issues with Ranbaxy are going to take a toll in terms of how they bid and the bottom line will perform. So I think those facts are known to the markets. But again, sharp corrections onto the stock, even from the current level, and if the stock does correct to that 800-810 mark, I think it's a very strong franchise, Nikunj. Again, the kind of A&D applications that Sun Pharma has got, the potential pipeline of 159 approvals and niche approvals that is along with Ranbaxy, I think that holds Sun Pharma in good stead, specifically for the US business. The domestic business, Sun Pharma Pharma, again a market leader with a 9.2% share. Abbott, the number 2 leader in the market with a 6.8% share. So there's a clear headroom for Sun Pharma in terms of how competition will pan out on the domestic front, and it is probably, I think, taking all the right steps in the domestic market as well. Cash on its books, and to a large extent, I think FY17 earnings should see strong rebound and earnings recovery. So if it corrects from these levels, say to those 800, 810 mark, as we've seen those levels earlier, I think you're getting a very strong company. And in such distressed time, I think such strong franchisees, if long-term investors can chip in, I think you're going to make a lot of money over the next 2 to 3 years.
Okay, just a minute left to go before we ring the opening bell for this Monday morning, the first in the month of November, done with the series, still in the thick of earnings amidst a bleak set of global setup this morning. So Sandeep, want to come to you. What could be the top stock trading idea for today?
It would be a sell in a Wokhart, stop loss of 1539, target of 1341, and it is a little long term, maybe for the week or so, but you can initiate a sell today in case of a little bit of a bounce back.
All 45 seconds to go, and what are we working with? Well, we are not working with excellent set of local fundamental cues. Indian markets suddenly has slipped into this underperforming zone, so to speak. Irrespective of how good and grand October was for global markets, Indian markets have not gone anywhere. Flows at best, some would argue, they are patchy. Global flows are stable. Global volatility is down, but there are a lot of local issues which suddenly have come to fore. Earnings, the fact that there is no big margin expansion, there is no big demand recovery which clearly has happened, and if companies like L&T and if banks like Axis Bank are feeling the heat of the economy, that just tells you that the underlying economic conditions are not the best. At least there is no improvement in the economic conditions. That is what is scaring me. So first rates, a brand new rate for the day, a brand new rate for the week, and a brand new rate for the month. It's there on your screen. Nifty 8,000 so far, or 8,050 so far is intact, but can really bulls defend 8,050 for rest of the day? I doubt it very much. It's a reverse rate on the Sensex, 52 points up on the Sensex. This could be aberration. This would align, going forward. For the mid-cap index, again, it's a flat start, and for the small-cap index also, it's a flat start. I want to start with L&T because L&T was under pressure. Markets reacted on Friday and brokerages reacted on Saturday, and the stock markets are now reacting to brokerage downgrades this Monday morning. So another 2% gone down for India's biggest construction and engineering company, L&T, and it's falling on very strong volumes. Within the first 60 seconds of trade, L&T has already clocked about 2 lakh shares, and that's a big number for a stock which is a 1400 rupee stock. Sun Pharma, the management continues to endorse the fact that there is an acquisition problem. Another 20 rupees gone for Sun Pharma. IOB, and what a howler they've reported for the quarter gone by, 11% straight off for IOB. So if I have to identify a real casualty this morning, it has to be IOB. And whenever Rare Enterprises, a company which is promoted by Rakesh Jhunjhunwala, they check in a stock, be rest assured the stock next morning will see a gap up open, and that is the story for Jet Airways. It's the high flyer, 461 rupees, up 24 rupees.
Oh yeah, it clearly is in the run-up to the Indigo IPO, and some heavyweights there checking into this one. That's Jet in trade for you. But you really can't take your eyes away from Sun Pharma and L&T. These are the biggest drags on the Nifty right now. Sun Pharma is your top loser. It's down 21 bucks. 868 is where the stock is, and L&T after the sharp plunge on Friday, today too it's seeing weakness to the tune of about almost 2% or so. Adani Ports is the only Nifty company which is going to come out with its earnings today, so let's just check in on that one as well. That'll come up for you on your screens. In the meantime, slew of other numbers that came out over the weekend, and Titan, it's been a disappointing set for them this time around, so I just want to see what the stock is up to. It's a gap down start, 5 or rather 6% actually now down on Titan. That's the word coming in. Century Enka, just a very small base number coming in there, but it's been a disappointing set. Tata Tele, that has come out with a weak set of numbers. IFB, the profits have halved for them this time around. 3M India has come up with numbers which have really doubled this time around. 3M India has come out with a very impressive set of earnings, 4% higher for 3M India. Gujarat Alkalis, V-Mart, These are all earnings the street would be reacting to. Suzlon, and I want to see what the numbers are looking like, because the top line may not really show all that growth, but the loss definitely has narrowed to the tune of about almost 5.5 odd crore rupees from the last time around, or rather 500 crore rupees. I stand corrected. 2.25% bump up is what you're seeing for Suzlon right now. A Merck, a GSK Pharma, these are all numbers the street would be reacting to right now. A Divi's Labs, no sparkle there, but yes, the net profits and sales have definitely come in higher this time around. Cox and Kings, now this has really been a turnaround quarter for Cox and Kings. Look at the jump up on the stock, 2% higher. They've posted a consolidated PAT of 118 crore rupees as opposed to a loss of 94 in the same quarter last year. So good numbers coming in there. Atul Auto could be the other one which could be in focus, and decent numbers there. The PAT has come in higher this time around. IDFC, they posted a net loss. 1469 is what they posted this time. The NII as well is under pressure, and that's IDFC in trade for you, down about 4.5%. By the way, the Sensex rates, the BSE Sensex rates are not really updating, so don't go by that ticker right now. Let's go by the Nifty, which has indicated a weak start. Flattish at that. So 80.58 thereabouts is where we are currently settling in, and just marginally in the green. I won't even say green. It's a flat start for the broader markets. To the mid and the small cap index line, absolutely quiet. But ICICI Bank and the auto majors, that's M&M, Tata Motors, Maruti Suzuki, they're all your top notchers right now. Mayuresh, what to expect from the monthly sales numbers from Motown this time around? And does it seem like maybe they could see a perk up considering festive season has now kicked in?
Every possibility, Aisha, and clearly I think the expectations are running high for the dispatch numbers to probably come through. But again, I think within this pack itself, one really needs to differentiate between the two-wheelers, the four-wheelers, and the commercial segment of things. So clearly within this segment itself, two-wheeler volume growth is something that can be a little bit tepid going forward if you just leave aside a month or couple of months for the festivities this time round. But clearly I think volume growth is going to disappoint on that front. So within the four-wheeler space, as I mentioned earlier, I think Maruti is somewhere where we believe the earnings growth should continue and the premium justification should continue. Ashok Leyland is something that we believe the long-term prospects are still existing with the stock. The LCV segment might be a weak link for Ashok Leyland this time around, but with increased production probably happening for Pannagar, fleet operator profitability increasing because of fall in diesel prices and volume growth happening at a substantial rate, I think Ashok Leyland can be a key beneficiary, as will be Eicher Motors. I think we're extremely optimistic on Eicher Motors, both on the two-wheeler story, which we believe, I think the numbers are just not dying down. The kind of dealer additions that Eicher is doing probably on the two-wheeler space is abetting its volume growth. Realization is extremely strong. CV side of the things remaining extremely strong for Eicher Motors, with EBITDA margin expansion quite evident, and even the MDP part, I think even that is showing strong traction. So clearly I think we're being extremely stock selective in the auto part. So Maruti, Ashok Leyland, Eicher Motors remain one of our favorite picks.
Right. Mayuresh, stay with us. I want to just mark the absolute casualty today, and the absolute casualty today is IOB. 13% down on miserable volumes. So I think the verdict is very, very clear that if stocks are falling and if there is no delivery, so to speak, markets are simply thrashing and punishing that stock. Be it a Federal Bank or an IOB or a Just Dial, I think on a daily basis we are getting one stock which is just losing its bottom. And bear in mind that expectations from some of these banks, at least PSU banks, are so diluted that nobody was expecting any growth. But the bad loan formation and the NPA book is just not recovering for some of these banks, and I think that is the real messaging from the banks right now, that the economy has not recovered. There is a lot of bad loan pain problem in the system. So this thesis that things will turn around one day once the interest rate once the interest rate cycle will start, or interest rate cut cycle will start, I think that clearly has got challenged. We've got a huge interest rate cut of about 125 bips in this year, and Mayuresh, despite a sizable rate cut, things have not reversed. A very a very basic ledge on which markets have rallied this year, earlier this year, was that interest rates will come down, economy will pick up, earnings will expand. But that very basic thesis has got challenged.
And that's exactly the point, I think, why you're probably going to witness, Nikunj, the earnings recovery probably getting delayed. So in every bit, I think the end user industry that a lot of these banks cater to, infrastructure, metals, real estate, sugar, I think all these industries are going through painful points. And though you've seen rate cuts happening to the tune of 125 bips, I think the actual transmission has been much less. So that's point number one. Point number two, probably, I think, though the working capital constraints might just come up a little bit for the end user industries, I think the top line growth is probably not happening at the pace one really expects. So I think the cash flow mismatch in terms of how the top line will probably grow up from the current levels for these end user industries, how margin expansion will happen, and again, I think what it really translates into bottom line is simply not playing out. So I think the kind of net issues that you're probably seeing on the asset side for a lot of these banks are going to be evident in the near to medium term. And clearly, I think even on the private side, I think the kind of ARC sale announcements that a lot of the banks are making post-Axis Bank numbers are testimony to the fact that a lot of exposure that even these banks have, specifically on the corporate side, whether that's an SME lending book, whether that's a power lending book, whether that's an infrastructure lending book, I think these assets are going to be under stress for some length of time. So clearly, I think within this space, if you ask me what I would probably choose at this point of time, Nikunj, the private space is something that we are still very comfortable with. Yes Bank has given a decent set of numbers in our opinion. HDFC Bank more retail driven at this point of time, and though valuations again are at a premium, I think these premium valuations stay because of the quality of earnings that these banks deliver. And again, I think Axis Bank might underperform, but clearly I think our take is that with credit cycle recovering and with earnings growth coming through in FY17, even Axis can be a good long-term pick.
Mayuresh, so good chatting with you. Thanks much for taking the time out and speaking with us with all the active buzzers in trade. So the news this Monday morning is it's a quiet start, but with a negative bias. We've breached that 80-50 mark currently in trade, and the broader markets too, after that bit of a marginal upside, they've begun